Good morning and welcome to this webinar that's the first take on the Commission's proposal from yesterday on the Multiannual Financial Framework covering the years 2028 to 2034. My name is Iben Schacke. I'm head of communications at think tank EUROPA, a Copenhagen-based think tank. And just to begin with some of the headlines from yesterday, we saw, as was also expected, a quite extensive reorganization of the new long-term budget into 4 pillars instead of the present 7 headings. We saw an increase, a general raise of the ceilings to 1.26% of the EU's BNI, though that also covers the paying back of Next Generation EU. We also saw new measures like a crisis fund above the ceiling and a new fund for the Ukraine. And of course, we also saw a new proposal for the EU's own resources to ensure, as the Commission President also said in her speech, that member states' contributions stay more or less the same. Those are some of the headlines that we are going to discuss this morning. There are a lot of things that the numbers that we still haven't seen. Also, we only have 1 hour, so we can only cover so much. But at least today we can start the debate on whether this budget proposal can actually deliver on the many European ambitions on competitiveness, on defense, on enlargement, and the green and the digital transition. And here today, this morning, I have with me Niels, Flemming, Hansen. You are a Danish MEP representing the EPP group. Thank you for joining us.
Thank you for having me.
Thank you. And we have Sophie Barbier. You are the Director of European Affairs Department at the Caisse, Dépôts et Consignations. Welcome to you.
Good morning. Thank you.
Good morning. Justinas, Mickus, you are a Senior Policy Analyst at the Lithuanian Government Strategic Analysis Center named STRATA, among other things. And you are also here today to provide your perspective on the MFF. Thank you for joining us.
Good morning. Good to be here.
Good morning. And Ditte, Brasso, Sørensen, you are the Vice Director of my organization, Think Tank EUROPA here in Copenhagen. Happy to have you with us.
Glad to be here.
And last but not least, we have with us also Philipp Lausberg. You are a Senior Analyst from the EPC, dealing with, among other things, of course, the MFF and budgetary affairs. Welcome to you as well.
Thank you. Happy to be here.
Okay, let's begin with a quick first round and the same question for all of you. Please answer briefly because we will also get a chance to dive into some of your answers. When you saw the presentation yesterday of the next MFF, what caught your attention in the proposal? And Niels, Flemming, I will start with you.
Well, thank you very much. And I think before we dive into the nitty-gritty on the Multiannual Financial Framework, or the MFF as it's known, I'd like to share a little anecdote from the Politico playbook the other day. A source suggested that we should simply think of the MFF standing for mojitos, flip-flops and fun. I don't know about you, but that certainly makes the MFF sound a little bit more appealing, doesn't it? Perhaps that's why the Commission wanted to get this proposal out before the summer break, to get us all in the mood for some serious MFF thinking. Jokes aside, yesterday was quite a day in the European Parliament's Budget Committee. There was a lot of discontent among MEPs, particularly regarding the Commission's presentation, or rather lack of presentation of the MFF documents in advance. It's rare to see such a united front from the pro-European groups, but I noticed that the EPP, S&D, Renew Europe and Greens leaders issued a joint statement expressing strong concerns about the direction of this budget, and it seems that there's a bit of drama brewing before the summer break. I also have to say that we read this. We got this yesterday evening, and so we haven't been into all the details of the budget yet. And just to remember that this is a negotiating budget that we will have to figure out how to land. I did some calculations yesterday from the old budget where it was like 1.2 billion euros, and kind of ran that through and said, okay, if we take in the increase of society and the increase of the inflation in the Eurozone, what would be the amount today? And that amount would be 1.52 billion. So when we talk about a raise, how big is that raise actually? So let's discuss that as well. But thank you very much for having me.
Thank you. And then Justinas, can you also give us your first take on the MFF as presented yesterday?
Thank you, of course. Maybe two quick things. One is, we're at the start of a 2-year process, and we saw in the last 2 weeks a sort of a good preview of how that will go. Insofar as the process is more important than the product at this stage of of the negotiations, things are looking risky. Because there are clear divisions across all 3 main institutions of the EU as well as between them, and there will be lots of severe choices to be made, stark choices to be made. It will be a tumultuous process. That's the first main sort of takeaway, of course, emphasized endlessly by the Brussels media. So I don't have to expand on it too much. But the second point is this. The suggestions, the proposals for the governance reform of the budget clearly increases, and I think in a welcome way, the responsibility of member states, first and foremost, to choose, to prioritize. At the same time, the reorientation of the funding priorities creates new incentives to defend certain interests, certain sectors, certain programs, certain stakeholders, which will make that really difficult balance of how we best plan it, how we best, focus our attention on the so-called European public goods or any other of these, MFF jargon words, much more difficult. So given that the success of the reform rests so much on the ability of member states to really plan in both a national and a European perspective, at the same time as the competition for what's not ring-fenced on how to preserve existing rents, etc., increases, it will be a very, very tricky balance. But it is a welcome discussion to begin with the EU. It's not known for choosing, and it will be good to start.
Yes, indeed, a very tricky balance. Sophie, what was your first take on the MFF proposal?
First of all, it's personal opinion and an opinion based on the available information at this stage. So it merits some qualification, certainly with further reflections and information. But my first reaction would be to say that this is an ambitious proposal in terms of architecture with some bold changes. And what is important, a clear effort, obviously, in terms of investment in infrastructure. But I have the feeling that there is one blind spot or something that is less tackled than anything else. It is implementation. And I think that the fact that implementation seems to be overlooked. It is the implementation that will decide on the success of this ambitious new budget. But I can come back on this later on.
Sure, thank you. Philipp, your first take on the MFF proposal.
I must say I was positively surprised. I didn't think the Commission would be that ambitious. And since the ambition of the Commission is really to provide a budget that is, responding to the challenges of our time, I think this is, this is a proposal that, fits that ambition quite well. Particularly, I was surprised about how big this competitiveness fund is supposed to be. In a recent paper, we have suggested it should be at least 300 billion. This is now even more, even though it's not quite clear how it's divided up and where, Horizon Europe will stand and other instruments. But yeah, I think that's definitely a bold proposal. We will see how much of that will be left after the negotiations. But I think it's good for the Commission to start putting the stakes high, because that makes it maybe more likely that some of it will actually become reality. And I think also when it comes to the the changes in architecture, I mean, you can see there's an ambition to make it simpler, more flexible, focus more on strategic investment, but also more on leverage and using financial instruments and conditionality. And most of that is also what we've been arguing for. When it comes to leverage, I think open architecture is mentioned in there. So the implementation through national promotional banks, through international financial institutions and EIB group and so on. I think it's something, it's in there. It could be spelled out more, and we'll see how they will turn out. But I think it's also important to leverage these partners' resources to get even more effect from the budget. So altogether, I think it's a positive reaction from my side.
Okay, thank you. Yes, and we'll get back to that, the architecture and what is actually in there to improve European competitiveness. Ditte, are you with us? Could you give us your first take on the MFF proposal from yesterday?
No, absolutely, and I think much has been said already, but I can only echo what Philipp just said, that it is, I think, also a quite ballsy proposal, actually. I think there's a combination of factors that make this a quite bold proposal by the Commission. One thing is the size, and of course we can dive into how big this MFF actually is, but I actually think the size is probably sort of the least impressive thing about this proposal, but still it is bigger than the previous MFF, so in that sense I think that's noticeable. But I think the combination of sort of having a somewhat ambitious budget frame combined with then introducing sort of this vast array of own resources, even more own resources than is needed to cover the repayment of the next gen funds, and then this quite significant, I think, redesign of the budget, which both has sort of more responsibility allotted to the national government, but also a lot more flexibility in terms of spending to the Commission. I think that is quite ballsy, and there was a lot of chatter and rumors in the weeks leading up to this proposal about how it would look, of course, so it's not sort of completely it wasn't completely unknown, but I at least sort of personally had my doubts on whether the Commission would follow through on these ambitions to sort of break with this old way of organizing the MFF. And I think just to wrap it up, I think the nature of the proposal on the table really sort of indicates that we are seeing a very emboldened Commission that has been emboldened over the past mandate as this sort of crisis manager in European politics, who has been a trailblazer when it comes to financing, debt, enlargement, setting policy priorities. And I really think with this proposal, where you then have a Commission saying, well, we need to do this in a radically different way. We need to look at agriculture in a radically different way. We need to look at the division of competences when it comes to sort of how do we organize the payout of this money. We need to look at that in a radically different way. I really think it sort of cements the Commission's ambition to sort of design the future of the EU very actively.
Okay, thank you. So you all agree basically that it was a ballsy proposal, as you put it, Ditte, that the Commission presented yesterday, and that we are also seeing a lot of structural changes. But if we start by looking at the size of the MFF proposal, there was a lot of discussion about that yesterday also in the Parliament. Niels, Flemming, Hansen, what do you and your group in the EP think about the size of the budget? So the first take.
Well, it's hard for me to say what my whole group is thinking about the size of the budget, since we haven't had a chance to discuss that yet. I've read about the concerns that Manfred Weber is out on. I think in the ideal world, we wouldn't necessarily need to increase the budget. However, we face a fundamental dilemma. We have a substantial loan from Next Generation EU to repay. That is approximately 24 billion annually from 2028. I think in total it's around 170 billion over the next MFF period. And there are many crucial investments that needs to be made across Europe, like defense and like clean tech. While the Commission stresses the national contributions will remain stable, thanks to the new own resources, which are expected to generate around 58 billion per year. I want to highlight a fundamental question here, because if we increase the budget, whether through GNI, joint debt, or these own resources, we need to ensure that citizens and national governments genuinely see and feel that they're getting more in return. They have to get, so to speak, bang for the buck. If that isn't the case, we risk facing greater opposition. And frankly, I think the Commission is a bit of a dilemma here. Also, how we could see more Eurosceptics win elections in the coming years. To highlight these two elements, on the proposed cooperative research of Europe, the core own resources, which aims to generate approximately 6.8 billion annually from companies with a net turnover about 100 million. I find that very, very hard to see becoming a reality. In my opinion, this comes too close to giving the Commission's power to start collecting taxes directly, which is a highly sensitive areas in the member states. And furthermore, I'm also hoping to learn more about the crisis mechanism, which could provide up to 395 billion in soft loans to member states in case of a severe crisis or threats. The Commission states that the activation of these loans will require a decision made by the Council, with the content of the European Parliament. What remains unclear is the precise structure for the repayment of these loans and how these substantial amounts will be managed if they were to be activated. I think that would be my answer to the first question. So, as I started to say, if you look at the inflation rate, we're halfway there, and then there are these own resources which can be good, and some of them are, and some of them are not. And I think especially core is going to be very, very difficult. Thank you.
Yeah, thank you. And yes, there are five proposals, right, in the proposal, and then core is one of them. That's for sure. Thank you for this, Flemming. Sophie, when you look at the competitiveness fund, which is now we've already seen it's quite big. It's about a quarter of the proposed MFF. Is this size enough to make a considerable difference for European competitiveness, do you think? And what would it take for this fund, or this part of the MFF, to make a difference?
Thank you for this question. It is indeed an interesting one, since this European Competitiveness Fund is, as you said, a big amount, 400. We don't know exactly. There are two figures, but 410 billion euros or 450 billion euros, including the Innovation Fund. So, is it enough? If we refer to the Draghi report, estimated the investment needs to 800 billion per year at the European level to finance the green digital transitions and the defense sector. So, with roughly 65 billion euros, if I take the 450 billion euros for 7 years. So if I do the math, we have 65 billion euros per year. We see that this fund will not fill the investment gap, of course, but is clearly also a part of the solution. But maybe we can go a little bit further. And here I come back to my preliminary remark. I think that it is really important to take into account the implementation process to be able to answer your question. So in a way, if this size can make a difference if this fund is implemented in an effective way. I can also refer to the InvestEU program under the current MFF. You know that this program, there is in this program a guarantee of 26 billion euros for the 2021-2027 period. But this 26 billion euros should trigger investments of 362 billion euros. So you have a leverage effect of around 14. So if you apply the same multiplicator, and I hope that I am not losing everyone here, but if I apply the 14 multiplier here to the ECF, then the ECF could trigger 6,300 billion euros over the period. That is to say, if I come back to the yearly approach, 900 billion euros per year. And then you see that you cover the investment gap assessed by Mario Draghi. So it is clearly, it's an illustration. I am not saying that we will reach this type of multiplier, but depending on the choices that will be made concerning the implementation process, and in particular the level of financial instruments, the type of financial instruments, the importance of blended finance, that is to say, the mix between European grants and national financial instruments. Depending on this, and depending also on the recourse to a network of implementing partners, what Philipp referred to as open architecture. So depending on these choices, you will be able to get more for €1 of European budget in terms of investment, or less if you do the wrong choices. So my answer is the ECF could make a difference provided the implementation processes are well chosen and appropriate. And I think that in this respect, InvestEU is certainly a good example of what can be done in the next MFF.
So really what you're saying is that this is just the first step, right? And all the difficult work is still ahead of us in implementing this next MFF. And of course, first you need to have an agreement on the MFF. Yeah.
And indeed, and I think that it is implementation is not only a technical issue, it's a political one, because you see, we are discussing the size of the different pockets and of the budget, but in the end, to tell you if it is sufficient or not, you will have to be aware of the way this budget will be implemented. It's really difficult to answer without knowing that, and in a way, yes, that's why I was a little bit concerned not to have more information on implementation at this stage.
Yes, and we're still waiting for that, and I think the commissioner for the budget also yesterday said there was a balance, right, between Brussels basically and how much freedom you give the member states in implementing this fund. So there's also that balance. Okay, Philipp, turning to you, in the current period, the EU member states have benefited from both the MFF but also from Next Gen EU. So when you look at the proposed size of the budget from yesterday, will that be enough, you think, to meet the ambitions? I mean, you said you were positively surprised, but is it enough to meet the ambitions of the union?
Well, I mean, if you add up the current budget and Next Gen EU, then you arrive at almost the same as this budget proposal. So it's around 2 trillion. One has to also then deduce, of course, from the current budget the repayment of the RRF. So it's actually a little bit less altogether. Nevertheless, I would say it's as I said before, it's a bold proposal, and I think we're getting we don't know if it's enough to meet the ambitions, but it's definitely a step closer to that. As Sophie has said, Draghi said we need 800 billion more per year in investment. Of course, that includes all kinds of investment, not just EU level, but also national level and private investment. But this budget would provide 280 billion per year, so that's already more than a quarter of that, which I think is quite substantial. What is going to be decisive, whether it can really meet the ambitions, is really about whether this budget is used in a way that it can crowd in enough additional private and public investment. And that comes also back to what Sophie said about implementation. This is about, using leverage, using the leverage to bring in partners with more resources, but also with the right expertise. That means, local expertise, but also sectorial, and that includes, maybe national promotional banks, but also private investors, insurance companies, pension funds, and so on. And but to get these large institutional investors on board, and also to get international investment more in there is important. And I think when looking at the current geopolitical situation, the United States has been there has been outflows of capital, so I think there's also a opportunity there for the EU to get more international investment in there. But again, this is about building the right infrastructure and making incentives and using the budget in a way that it can crowd in this investment, making it attractive for others to invest in the EU. And for that, we of course need the savings and investment union that needs to be advanced. So we need integrated capital markets. We also need more tradable assets where institutional investors can actually invest in the things that are important for the ambitions of the union. So strategic areas like clean tech and deep tech, but also infrastructure and things like that. And I think we need to advance a stronger role for the euro in the global sense. That also will attract more money, and the Commission can do things there as well. For example, a digital euro, which is being discussed at the moment, and again also creating more tradable assets. For example, you can do that also through securitization. And then I think also international partnerships with other countries where you spend the EU money in a way that you could create joint funds with Norway, for example, but also cooperate with sovereign wealth funds to really get more bang for the buck, so to say, of this budget. So I think it really depends on how well the money is spent, but generally I think what is there is quite substantial, and if it's well leveraged and well used, it can go a long way to actually meet the ambitions of the union.
Okay, thank you. So what you're saying is that it's basically just as important that we get, a well-functioning capital market to make sure that this MFF will actually work out in real life. That's like one of your points, yeah?
Yeah, definitely. Yeah, it's one building block for sure. It's a very essential one.
Justinas, do you have a remark on the competitiveness fund and the size of it from yesterday? Yeah.
No, I really appreciate Philipp's point about, I would say, like the sort of enablers that are outside of the budget, but the key integration milestones that the EU still needs to take, especially with regards to savings and investment capital markets union. My other point is that, not so much about the size, but about the effect of the competitiveness fund is what will be the differential access to the programs and the funding opportunities by different member states and businesses therein, because we can see that the budget overall, and this will be maybe the next section of the discussion, refocuses some of the priorities, but they don't disappear. A lot of countries that relied heavily on CAP, on cohesion, will insist on that. Countries that will lose that will want to gain more from the competitiveness fund. The way that this balance is struck, for whom the competitiveness fund is designed, to be most, used for, will be a key question. And I think a lot of the smaller member states will have a lot of concerns based on previous experience on to what extent they're able to access sort of investment programs that are based on sort of quality of or potential of their businesses, of their STEM research capacities, etc., R&D capacities, etc. And to what extent the design of the programs is open to it. But that's beyond the question of size. It is much more related to the question of implementation. So I reiterate very much what Sophie said.
Yeah, another point on implementation. Ditte, you had a short remark on the competitiveness fund.
Yeah, no, I just wanted to. So I completely agree with the points that has already been well put on implementation and sort of the importance on the concrete sort of measurements through which these funds are being funneled from the MFF into the economy, and also the point made on the capital market as a crucial enabler. But when looking at these enablers, I just also wanted to throw in that I think another enabler that would be really crucial when looking at how to sort of design an industrial policy around strategically important areas, clean tech, energy, so forth, will definitely also be this sort of targeted relaxation of state aid rules. So there we're really back to sort of this balance in this MFF where you, on the one hand, you say, well, we need more flexibility on the European level so we can funnel money to the areas that are in need, and we might not be able to foresee those areas 7 years ahead, so we need a lot of flexibility. But on the other hand, we also need the states to really sort of strategically invest and thus relax state aid rules when it comes to building this industrial policy. So I do foresee that this MFF will also be in some ways actually sort of enabled or backed by a quite sort of substantial state aid funding also. So I think that's also where we really need to see some kind of coordination tool, some kind of at the European level prioritization to ensure that state aid financed industrial policy with money, of course, also flowing from the MFF is not sort of getting too broad, but is actually sort of strategically prioritized still. I think that's sort of a main challenge in this new sort of competitiveness fund way of thinking.
Absolutely, and the state aid rules, of course, goes to the core what the single market is all about and the level and playing fields and all this. Niels, Flemming, going back to the question of flexibility, the Commission has proposed a merge of many existing programs. What does your group in the EPP think about this new proposed flexibility in the MFF? Because we've seen Parliament being a little skeptical towards this.
I think a little skeptical is a stretch, isn't it? Well, the Commission's proposal indeed entails a fundamental redesign of the EU budget and aiming for a greater flexibility, simplicity, and transparency by grouping, I believe it's over 540 programs into 27 national plans. My group, along with many others in the Parliament, holds a critical view on this, especially concerning the common agricultural policy, the CAP, and the cohesion policy. As my colleague Siegfried Murason from our group put it, this proposal risks renationalization of the EU budget. For example, I read that critics highlight the MFF would mean a 20% reduction in the proposed CAP budget. Mm-hmm. However, on a personal level, I am a bit more optimistic about the Commission's approach to this. The idea of integrating different funds to avoid overlapping funds with the same objectives, with different timelines and criteria, which makes it difficult to apply and create redundancy. I think that is sound. I think I always had in politics the same as I do in my business. I say that we have to make it simple for our customers to do business with us, and EU needs to make this simpler as well. And I think this plan does that. A national plan approach allow for cross-fitting strategies, making it simpler for local and national authorities to manage. For example, for issues like housing, where you currently struggle to find the right fund, a broader national plan could be much more effective. So I don't think it's as bad as everybody's talking about in Brussels. I think it's I'm a little bit more optimistic. Thanks.
Okay, so a little simplification is good also for the MFF. Justinas, I'm going to turn to you as a sort of a representative from a smaller member state. There's been some criticism from at least from some member states that the Commission is wanting to reduce the agriculture and regional envelopes too much, even though it's approximately the same number we saw in the proposal yesterday. But also there's been some resistance in what some member states see as a sort of a centralization and steering of the member states by requiring performance and reforms in return for EU money. So this formula cash for reforms that the Commission has said that they want to strengthen in this next MFF. What is your take on this?
Yeah, so all of that you said is true, but with a ton of caveats. I will say, and echoing Niels' diplomatic statement about the EP, the European Parliament being somewhat discontented. My contacts in the national parliament shared with me that they have not yet met a single person at their, counterparts across the member states that really fully supports a sort of cash for reform model if it is to follow the RRF. So I think there was a lot of concern, while still having, and I think it's just that, people see the signs of the times, that a simplification is needed, that a more strategic political approach to the budget is needed. I think for countries that have historically relied a lot on cohesion, because they've benefited both from single market integration and from cohesion specifically, they're growing, they're performing well economically, so they know that in the future, even if the rules were unchanged, the relative importance of those funds would decrease as their economic level increases. The funding for breakthrough, policies, let's say, or competitiveness policies would increase. So there's been this discussion has been a long time coming. I think it was already well on everybody's minds in 2020, but Corona, shuffled up the cards. So everybody was skeptical about the idea that the cuts would be drastic and that the model of RRF would be followed too closely. But on both, there are, I think, significant concessions that any member state that is wary can take. And I think one good example from my region, let's say, is that while the ring-fenced, sum of money for CAP is smaller by around 30% than the, equivalent of the previous MFF, there is quite a strong commitment to ensure the so-called external convergence between the funds that farmers get in the more recently, accessed member states, the 2004 cohort, than the rest, and that's, I would imagine, ultimately a compromise that a lot of these countries could fathom and could accept. And so I see a lot of these safeguards, so to say, political safeguards, political compromises that the Commission has already staked into the proposal that will probably politically de-escalate, because the idea that we need to focus on European public goods, broadly conceived, I think is well entrenched. It is, however, interesting, and I will say this just as a last point. Our president last night tweeted, his first impressions of the MFF, and I single out the president because he represents us at the UCO. He will be there in the last minute, inevitable 11th hour debates on the MFF, in 2 years. His first sentence was, we welcome a budget that focuses more on defense and competitiveness, etc. It was very 2025. And the second question listing the top priorities was very much 2004 or 2014 or 2019. Cohesion, CAP, and then eastern flank and Ukraine in that order. So I think there will be a lot of things that have not changed, and we will see how the Commission can navigate it. I think it has put areas where it can climb down, where it can give something to the discontented parties, and hopefully that is successful.
Oh, thank you very much. That's very interesting, the tweet from your president. Just to say that, maybe the burning platform is not really there yet to fundamentally change the MFF, but we'll see about that. Ditte, turning to you, in your opinion, looking at both the structure and the size of the MFF proposal, how well do you think the Commission manages to merge sort of all priorities, the green transition and digitalization, with the more new priorities of competitiveness and defense?
No, good question, and I wanted to sort of use Justinas this sort of sense that the MFF is very 2025, or that was sort of in the tweet, or at least I think the way the MFF proposal reads is very 2025, in the sense that it's very clear that sort of political wins when we look at the policy areas that are being prioritized has sort of radically shifted when you look at sort of the headlines and the sort of the sharp increase in defense spending, the competitiveness fund. It's very sort of front of stage, these sort of new flagships of the Commission. So in that sense, it is a very 2025 reading proposal. Obviously, as you also allude to, Iben, and as Justinas also alluded to just before, there are abundance of old priorities behind those headlines. So there's still green transition, there's still digital transition, obviously also still CAP and regional funds and so forth. I think when you look at the green transition, which was, I would say, sort of the pivotal sort of flagship of the past Commission's mandate, it is noticeably still there, in the sense that there is a big focus on modernizing the European energy grids, that there is an ambitious climate mainstreaming target on 35%. So it's definitely there, but I also think it's quite visible that even sort of the old, if we could already call it that, the old flagship of green initiatives and green transition is sort of viewed through this prism of competitiveness and security. And when you look at the headlines about sort of what are then the green initiatives in this MFF, what all the chatter was about yesterday was that this is like a fivefold increase for European grids, which is obviously closely related both to the competitiveness agenda, in the sense that it will help bring down energy prices for European industry, also for households, but also for industry, and also obviously very, very closely tied to the security agenda, in the sense that it would sort of bring down import dependence on foreign energy. But I also think, looking at the climate mainstream target, that when you look at how that's being formulated, it has sort of a very sort of strong focus on preparedness and resilience and climate adaptation. So you can also sort of lump investments into that climate mainstreaming target that is closely linked to the security agenda. And that just shows that even the old flagships are being sort of reformed and reshaped through these newer ideas. And I think that there are trade-offs there. I think, looking at areas sort of such as in environmental policy, biodiversity, nature, soil health, that whole sort of bundle of issues that was more sort of forcefully tackled a couple of years back in the Farm to Fork and so forth, that is not that header or that subheader is not present in the current proposal. These policy areas are sort of lumped into Pillar 1 and perhaps also a little bit in the competitiveness fund. And I do think that shows that there is sort of a trade-off to be made, and there will be a trade-off between the older and the newer policy priorities.
Mm-hmm. Thank you. And I just, Justinas, just returning to you for you mentioned that one of the priorities of your president was security. What about enlargement? Is the MFF sufficiently enlargement ready? And what about this new fund for the Ukraine?
Yeah, so thank you. I mean, there are two, I guess, ways to see the MFF proposal from the enlargement lens. And one is just the funds allocated to the Eastern neighborhood and enlargement countries to support their policy reform, to support pre-accession activities of various kinds, including to the civil society that drives the bottom-up, mobilization for accession. That's there. That is larger than before. However, of course, the agenda is much more robust than it was at the start of the last MFF cycle. So, to what extent the relative increase in funding matches the relative increase of the salience of the enlargement agenda and the needs and the urgency, I think that remains up to debate, but I would generally view it as a positive thing that explicit connection has been made. But there's the second lens to view enlargement, which is and the enlargement proofness of the MFF. The Commission is very explicit about the fact of accession necessitating a revision of the MFF broadly. So I think it's good to have that clause there. It signals a certain, on the one hand, inability to commit to a certain expansive, ambitious sort of enlargement line in the budget right now, but openness to tackle that question in the future. I guess there's also the third element of what the MFF and enlargement connection is. And that is the sort of, insofar as enlargement is not a financial and a technical problem, but a political problem, let's see what the potential changes to the MFF can do to the political obstacles of enlargement. And if our hypothesis is true that we're shifting away from, agriculture and cohesion, even if it's a contained decline, these are the two areas where we're very likely to see a lot of public political discontent about the enlargement agenda in general. Farmers will be and are already sensitized to, Ukraine as a threat to their livelihoods because it's just so much more massive of a agricultural superpower. Precarious regions, as well as precarious societies within more developed regions, are of course concerned about labor migration, about businesses shifting away, labor shifting away, etc. So insofar as these questions will become more salient given the upcoming debates about the MFF, expect many more sensitivities about how our MFF plans affect our enlargement plans. And I would say especially watch for 2027. We'll be in the late stages of the MFF negotiations. We'll have the presidential elections in France, a country that has one incredibly a superpower of a region, and then mostly regions that are, middling in the EU, meaning that they stand to lose a lot of the cohesion funding, meaning that there can be a lot of political sensitivity there. As regards to Ukraine specifically, I think, the ambition of almost 100 billion to the special facility that per annum, I think, is a continuation of the Ukrainian facility allocations is a good sign. To the extent that it's a special instrument, I think, again, I view it both as a necessary safeguard and to some extent, a measure of flexibility. On the other hand, there have been opinions that something within the budget would have signaled a stronger commitment. I think a lot of countries that are really enthusiastic about the enlargement agenda would ask about the Moldova facility and what is the specific future of Moldova in the now reformed Global Europe instrument. So again, as with everything else, given that it's the start of the process, there are many open questions, but I think there are at least a couple of lenses to how to view all the impacts, financial, sort of technical, and then especially the political one.
Yes, thank you. Okay, we are running a little bit out of time, but I just wanted to briefly touch upon the own resources. Niels, Flemming, you had comments about core in the beginning, but Philipp, turning to you, in a recent paper, you suggested and that's what we are talking about, right? The European ambitions on competitiveness, defense, and so on and so forth, that something can be achieved through off-budget instruments and coalitions outside of these sort of established frameworks, through coalitions of the willings and things like that. Do you see that as still see that as necessary, and do you see a political willingness to do that?
Well, how much that is going to be necessary very much, I think, depends on how much of the proposal will be accepted by member states and how much funding we get in the end. But there are certain fields where this kind of model is, I think, can be more useful and more likely. And one of them, of course, is defense, where you have a couple of member states who are sort of have pacifism in their constitutions. Others are have different interests, plainly speaking, thinking about Hungary and so on. So it makes sense to have a sort of more select group. And of course, when it comes to defense, it's also the issue that the EU budget is not allowed to really directly procure weapons and things like that. So there's a case to be made to do that off budget. I mean, we have the European Peace Facility that is mainly used for supporting Ukraine, but I think there's also a case to be made for an instrument that should be set up by taking on common debt to finance European common procurement, and invest in military enablers and so on. The readiness for that is at the moment it's not really there. I mean, this discussion has been going on for the past half year. There's been the SAFE instrument where EU budget headroom helps member states to raise debt. But my understanding is that the more the pressure is rising, also, for example, if you have a peace deal in Ukraine that emboldens Russia, this could become more urgent, and something like that could actually become a reality. I think there's also other areas where off-budget instruments could become interesting. Also, when it comes to investing in scale-ups and in breakthrough innovation, we see that the United States, but also China and other countries increasingly use equity instruments to invest in these fields. So you have the Stargate initiative that Trump launched, where you have a 500 billion fund on to invest in AI, but also the Pentagon taking equity stakes in mining companies and so on, and of course China using government guidance funds to invest in their economic policy. So I think there's a case to be made to use this kind of equity fund off budget, because it's much more it's easier to do it off budget, but also it could help to have it with a more flexible membership. So I think there is definitely room for that. How much room is really also depending, as I said at the beginning, on how much of the proposal will actually get through.
Okay, so that's where the political willingness lies. Ditte, turning to you, the discussions on the new own resources is always sort of politically sensitive, and is also the question of common debt. How do you see this potentially affecting the sort of internal power balance between the EU institutions and the member states?
No, I think this is hugely interesting, and this is really also sort of a question where I at least have my doubts about the political willingness to actually introduce these own resources. I think way back when the next gen loan was agreed upon, there was a lot of sort of high-pitched writings about this was sort of a Hamiltonian moment for the EU, collective debt of that size. But I think, truth be told, sort of the real Hamiltonian moment would be if they adopt the own resources or sort of the common tax base to finance the common debt. That's sort of the real Hamiltonian moment, and we are still in some sense awaiting that in the European Union. So yes, we agreed on the debt, but we have not in any way yet agreed on the repayment of that debt. I think one thing that was quite noticeable just from yesterday to today, so the last 24 hours, was how self-evident everyone all of a sudden seemed to think that it was that the MFF cannot bear the brunt of the repayment of the next gen loans. And that's where this sort of whole sort of is the MFF proposal big or not big or not question comes into play, because it's not that big if you deduct the MFF or the next gen repayments, but I think it's not self-evident that we should not allow the repayment to be felt in the MFF. And I'm not saying that I personally think that would be sort of better or worse. I'm just saying that it's quite interesting that all of a sudden everyone seemed to agree that the MFF cannot bear any part of the repayment of that loan, which is, I think, quite sort of elegantly spun by the Commission, that you can just subtract that and then you end at a sort of a more reasonable budget. I think as Niels Flemming also alluded to in the beginning of our webinar here today, several of the concrete own resources or ideas for own resources proposed have already been met with sort of quite high-pitched opposition. There's the idea to tax big companies, which has already been debunked by Germany. There's the levy on tobacco. Sweden has been out and saying, well, that is sort of over their dead body. And it just goes to show that this is sort of an discussion that has been ongoing in theory for years, where we agree that we probably ought to do this, but there's very sort of limited political willingness to actually then agree on the concrete measure. Also because each concrete measure sort of entails a decision to be made on the redistributive logic. I mean, is this the polluter who should pay? Then we could look to the European trading, the ETS system. Is this the smokers, or should the rich countries pay? I mean, who should actually sort of pay most into these own resources? And I think there we would just see massive fights. And I'm quite concerned that we would actually not reach agreement on these own resources. But I still think it's probably the right way to go. And I think, as I also said in the beginning, that it's very bold that the Commission puts out a proposal where it actually says that it want to introduce own resources that will finance double the amount that is necessary for repayment. So I think it's a bold proposal. I'm concerned about the political willingness, I would say.
Yes, and looking at the years ahead, we know we have at least a year and a half, probably 2 years of negotiations ahead of us now. And just because we're running out of time, just a short final question for all of you. Where do you foresee the trickiest part of the negotiations ahead? And I'll start with you, Sophie.
Maybe you may think I am a little bit obsessed, but I think that it will be concerning the implementation, and it is something that will have to be discussed, because we know that the final size will depend on very long negotiations between the institutions, European institutions, but at the end, the budget will not be sufficient to meet the investment needs, whatever the final point of negotiation. So we will definitely have to find ways to make €1 more efficient in the next MFF. And in this respect, I come back to the idea that implementing partners can play an important part in this.
Thank you. And Niels Flemming, where do you foresee the most tricky part of the negotiations?
Well, like Sophia said, implementation is tremendously important, and it is with all things that we do in EU. So more levelized implementation all over EU would be one thing. I think own resources, how to get income to EU is going to be a hard struggle. I don't think that we have seen the last proposals on how to get money into the system. And I don't think that the way that it's looked into the budget now seems to be going. I don't think this is where it's ending, but I think that the amount of the 58 billions is. I don't know if it's enough, but at least that I think the amount will stand.
Okay, thank you. And Philipp, your take on the trickiest part?
I think the trickiest part is to really, convince member states that agricultural funding and cohesion will be reduced. I think that's going to be the toughest. When it comes to implementation, I think actually I'm quite positive on that. I would say that leveraging the budget more through open architecture and so on, I think there will be an understanding for that. And I also wanted to mention that a lot of that is in this report that was published recently by the EPC. If you can read it on the EPC website, then you find more on it.
Yes, please go and read it. And Justinas, your part.
So first of all, fully agree with each of those candidates for the trickiest part. I think, implementation, governance, own resources, the political mindset shift, all will be tricky as far as negotiations concerned. So to the kettle of tricky things, I would suggest that we're not only shifting from traditional MFF to a more competitiveness and investment-oriented or strategic MFF, we're also shifting from a sort of neoliberal conception of competitiveness, horizontal, open, fair competition, to a much more economic statecraft and strategic economic policy making throughout the EU. And there is no guarantee that we have the capabilities, we have the instincts, we have the mindset. The uncertainty that each member state will experience in trying to prioritize its growth pathways in the future will make the council overall a very, very difficult negotiating partner, because it will be a lot of people who have some but not a full idea of what they want in the next 25 years. This will be a very tricky part, because it will create so many collective action problems.
A good point. And Ditte, your take on the trickiest part?
Well, I mean, you could approach this several ways, right? I think the trickiest part will be own resource. I think deciding on who should bear the burden of repaying the next gen loan and why will just be in principle discussion, tricky to agree on. There's so many, both in terms of redistribution, but also in terms of competences, and as Niels Flemming also alluded to in the beginning, should the EU be able to sort of get direct taxes and so forth. I think that will be very difficult. I think what I'm most worried about is actually also what Justinas pointed to in his remarks, is to say, well, if we are looking into a more active industrial policy to sort of build competitiveness, I mean, how do we then ensure that economic statecraft model is prioritized in a way that it actually supports competitiveness, and that it's not just 27 industrial plans pointing in each their direction. I think that's sort of my main concern, that the EU would actually sort of build the policy initiatives and measures into sort of coordinating that industrial policy. That's my main concern.
Thank you. And then we're back to the implementation discussion again. So thank you so much for all your insights. There's for sure much more to be covered in the proposal than we managed to do today. But I think we got off to a pretty good start. So thanks everyone also for listening in on this webinar. And on behalf of the European Policy Center and Think Tank EUROPA, have a good day and goodbye.
Thank you.